Trump tariff tantrum. March saw the S&P 500 index slump minus 5.8% on the back of US President Donald Trump threatening to impose tariffs on countries around the world. Yesterday, in what Trump has called Liberation Day for the United States, the US has imposed reciprocal tariffs on countries around the globe at a rate of half of what those countries levy tariffs on US goods. As expected, the stock market has reacted negatively to this news. As of this morning, 3rd of April, US futures are down about minus 3%, as a trade war will quite possibly slow global economic growth and potentially lead to higher inflation and interest rates staying high. Even with this volatility, in March, I managed to once again beat the S&P 500 return for my clients whose fully offshore share portfolios in US dollars I manage on a full discretion, fully managed basis. As mentioned in my previous videos, this is not a long-only strategy. That is why I've been able to achieve positive returns for my clients, even while the stock market has been falling. The returns are uncorrelated. I expect to return double-digit annual returns to my clients, whether the markets go up, down, or sideways. I'm trying to achieve consistent and stable returns for my clients. That's the objective. Just a disclaimer, of course, it is a high-risk strategy. There are risks involved. Past performance does not guarantee future results, and the minimum initial investment is $18,000. Once again, massively grateful to my clients who have entrusted me with their hard-earned savings to manage on their behalf. Just looking at the performance so far this year, we did 5.9% in January, 3.8% in February, and March 5.8%, total of 16%, just over 16% for 2025 so far. And if we compare that, looking at a chart below here, my clients have done 16%, whereas the US markets have fallen over 5%. So I have been managing clients' money for quite a while now, since 2020. However, I did start a new strategy in October last year, and things have changed significantly since then. Returns using that strategy last year have been 1.4% in October, 4.2% in November, and 5.5% in December. In times like this, I feel it is important to invest your money with people who know how to navigate the ups and downs of the market, and particularly not invest in long-only strategies. We often hear the saying, it is time in the market and not timing the market. I agree with this statement to a large degree, but what if you're investing a lump sum and you do not want to invest for 13 years or more? Perhaps you are older than 65, then would investing for the long term make sense for you? An alternative is hedge funds that can benefit from the markets going up and down, or managed accounts like I'm doing for my clients, as shown above. Just to illustrate an extreme example, below is a chart of the most widely followed stock market index, the S&P 500 index, which tracks the largest 500 companies listed on the US stock exchanges. As you can see, there was a massive rally from the mid-1990s till 2000, and it was called the so-called dot-com bubble, which then eventually burst, and there were drawbacks, pull downs in the market, quite significant. So had you been very unlucky in terms of timing and invested a large lump sum in 2000, you would have had to wait a full 13 years just to break even. For 13 years, your investment would be showing losses. You only would have broken even in 2000, well, briefly in 2008 before the market collapsed again, and then you would have broken even again in around 2013. Now, had you been extremely patient and not sold during those painful 13 years from 2000 till 2013, your investment ultimately would have performed very well. As per the chart below, the markets rallied strongly after 2013. The recent AI revolution rally recently does remind me a little bit of the dot-com bubble. There are some similarities in the sense that the so-called dot-com companies had very high valuations before the dot-com bubble burst, and some AI companies have also traded on high valuations by the end of last year, although maybe not as extreme as before the dot-com bubble burst, and some AI companies are showing real strong profits and revenue. So, what can we learn from all of this? One lesson is that patience is very important when investing. Timing is important if you are investing a lump sum investment, especially if you do not have at least 13 years to invest. It's a little bit easier if you're investing on a monthly basis, because then it doesn't matter too much if the markets are falling, because you do your rand cost or dollar cost averaging, where you're buying the index or stocks at a lower price. But when it's a lump sum, one needs to be very careful in terms of timing. It is important. So especially if you do not have 13 years to invest, it is important to invest your money with investment managers who have experience in providing their investors with positive returns, even when the stock market is going down. Like hedge fund managers, or like, as I said, what I'm doing for my clients offshore. I would love to hear your comments about this, if you have an opinion about timing the market versus time in the market. Just moving on now to the best performing stock markets so far in 2025. From 1st of January to 31st of March, Poland up 32%, Czech Republic up 27%. So European markets are basically doing quite well. They've gained 5.2% so far this up until the end of March. UK equity is also doing pretty well, whereas as mentioned previously, US markets not doing so well. They've come off quite a bit. So it just shows the dominance of European and emerging markets during the first quarter of 2025, with US markets facing significant challenges. Just looking at the US listed mega caps, the large ones, over $200 billion market cap. Berkshire Hathaway up over 18%, Exxon Mobil up 11%, Visa up almost 10%, JP Morgan up 3%. In terms of the worst performers, Tesla down 30%, Broadcom down 25%, Nvidia down 18%, Alphabet, Google down 17%, and Amazon down 11%. Looking at South Africa on the JSE, companies with a market cap of greater than 500 million rand. The gold shares absolutely flying. Harmony Gold up 85%, DRD Gold up 81%, Goldfields up almost 75%. And the platinum shares also doing quite well after not performing well for a very long time. They're starting to show signs of movements. Impala Platinum up 38% almost, Northern Platinum up 35%. And then even the telecoms groups like MTN and Vodacom doing quite nicely so far this year. In terms of the worst performers, the construction company Wilson Bailey Homes down almost 23%, Sappi down 23%, Spar down 19%. Yeah, so just looking at the gold price itself, has gone up almost 18% this year, quite a big move in gold, and hence the share prices of the gold shares done well as well, and the platinum price up almost 10%. So there we go, a nice summary of what's been happening this year so far. If you have any questions or just want to chat, you can reach me at warrenis@afrifocus.co.za. That's warrenis@afrifocus.co.za. Hope you have a fantastic week ahead, and we'll chat soon.